The moment of maximum financial pain is not a random occurrence. It is the mathematical result of overlapping systemic constraints that force market participants to behave in direct opposition to their own long-term interests. Liquidity is often misunderstood as a static property of an asset. In reality, liquidity is a function of market stability. In periods of low volatility, the bid-ask spread remains narrow, creating the illusion of easy exit. However, when volatility spikes, liquidity evaporates precisely when it is most needed. This phenomenon, known as liquidity drying, means that the cost of exiting a position increases exponentially during a downturn. Forced selling is the primary driver of market bottoms. When assets are held on margin, a decline in value triggers a maintenance call. If the participant cannot provide additional collateral, the broker is contractually obligated to sell the assets regardless of price. This creates a feedback loop. Lower prices trigger more margin calls, which lead to more selling, driving prices further down. Retail investors often overlook the structural constraints of institutional funds. When a mutual fund or ETF experiences high redemption requests from investors, the fund manager must raise cash. This often requires selling their most liquid positions first, even if those are the assets they would prefer to keep. This forced selling by institutions creates downward pressure that has nothing to do with the fundamental value of the assets being sold. Modern portfolio theory suggests that diversification reduces risk. However, in a systemic liquidity event, correlations tend to converge toward one. Assets that usually move independently begin to move in unison as investors sell whatever they can to cover losses in other areas. This breakdown of diversification means that a portfolio that appeared balanced in a bull market becomes highly concentrated in its risk profile during a crash. Market participants do not receive or process information at the same rate. Institutional high-frequency systems react in milliseconds, while retail sentiment often lags by days. By the time a price decline is widely reported in the news, the majority of the structural selling may have already occurred. Selling at this point means entering the market after the information edge has been completely exhausted. The most common reason for selling at a bottom is a duration mismatch. This occurs when an investor uses long-term capital to fund short-term liabilities, or vice versa. If an individual requires cash for an immediate expense, such as a mortgage or business cost, and their capital is tied up in a depreciating asset, they are forced to sell regardless of market conditions. Proper duration matching ensures that capital needed within a short window is never exposed to high volatility assets. Investors tend to anchor their perception of an asset's value to its recent peak. When the price drops, the gap between the current price and the peak is perceived as a loss, even if the position is still up from its original purchase price. This cognitive bias creates a sense of urgency to stop the bleeding. When the pain of this perceived loss exceeds the investor's threshold, they sell, often at the exact point of maximum exhaustion for the downward trend. In engineering, critical systems have redundancies. In finance, that redundancy is cash. Holding a non-productive cash balance is often criticized in bull markets for its drag on returns. However, cash serves as a structural buffer that prevents forced selling. It provides the optionality to meet liabilities and even provide liquidity to others when it is most scarce. Without systematic redundancy, a portfolio is optimized for growth, but fragile to shock. The ability to avoid selling at market bottoms is not a matter of willpower, but a matter of structural design. By understanding the mechanics of liquidity, leverage, and duration, an investor can build a system that remains robust when others are forced into liquidation. Market bottoms are created by those who must sell. Resilience is achieved by those who do not have to.